Welcome to ADB's Asian Development Outlook, where we explore the economic prospects for developing Asia and the Pacific. Amid global uncertainties, our latest report highlights robust growth for the region, tempered by external risks. Today, we're joined by Albert Park, ADB's chief economist, to discuss the trends shaping the region's outlook. Albert, thank you for joining us. Can you share the key findings from ADB's latest report?
We expect growth in developing Asia to be resilient thanks to strong domestic demand, improving exports of semiconductors, and a gradual rebound in tourism. Overall, we are projecting that developing Asia will grow at 4.9% this year and at the same rate next year. This is a slight upgrade from our previous forecast for this year that we had announced last December, and that's mainly because we've upgraded somewhat our growth projections for China.
What are your expectations for inflation?
We expect inflation to moderate in Asia and the Pacific this year, partly because global inflation has come down and also fuel prices have stabilized. Overall, we're expecting that inflation will be 3.2% this year and 3% next year in 2025. And in a lot of countries in Asia, other than China, we still see inflation rates higher than what they were pre-pandemic. And one contributing factor is that rice prices have really surged. That's because of adverse weather shocks and also export restrictions that have been imposed by some countries.
What are the main risks facing the region's outlook?
Conflicts we still see in Europe and the Middle East, and geopolitical tensions. The second risk factor would be U.S. monetary policy. If inflation is a bit more persistent than expected, the Fed could keep interest rates higher for longer. A third risk is China's property market. The Chinese government is doing its best to try to address some of the long-standing imbalances in that sector. And finally, climate change and El Nino. So we're still expecting more disasters and weather shocks, which could be a problem for countries in the region.
What type of policies could help manage those risks?
Policymakers in the region need to stay vigilant because there are different types of risks and may have to respond quickly, whether it be in terms of monetary policy or fiscal policy. Monetary to respond to inflationary pressures while trying to support increased investment and growth. Fiscal policy to make sure that vulnerable groups are protected if there are shocks to the economy, but also think about ways of generating more revenue so that they can finance not only the short-term financing needs for supporting these vulnerable groups, but also continuing to be able to make investments that can support longer-term growth, meeting the Sustainable Development Goals, and of course, addressing the climate challenge.
How might a prolonged downturn in China's property market affect the region's growth?
The direct effects of slower property market development in China does not spill over very much to other countries because it really affects the construction sector. It will mainly affect demand for materials, and there are some countries like Mongolia or Australia that do provide a lot of construction materials to China. But otherwise, the direct effects on growth would be quite mitigated. But if the property sector downturn leads to a broader loss in consumer and investor confidence in China, that could then affect consumers' willingness to buy everything. And that could have obviously more important implications for import demand for the rest of the region.
Artificial intelligence has become a buzzword in today's economy. How do you see its impact unfolding across the region?
I think we're really still at the very early stages of the AI revolution. We are already seeing that in the semiconductor sector, a lot of the investment demand and a lot of the production and exports are related to the demand for AI, which is really skyrocketing. But of course, later, as AI gets more widely adopted in society, it's going to start affecting employment. It's going to start making some workers more productive, but also maybe substituting for other workers and leading to challenges in job creation. And so governments need to start to plan for those eventualities. They're thinking about how they can develop AI in their own economies and use it productively, but also kind of keep in mind some of the challenges that are going to arise with AI and how to manage those challenges as they emerge.
Thank you, Albert, for sharing your insights. For more data and analysis, head on over to adb.org/outlook.